Buckle up and keep your hands and your feet inside the ride at all times. And that ride is the oil market roller coaster. It rolled on today. Crude moving higher, nearly 3%, as OPEC and its oil-producing allies agreed to simply continue to increase their output each month by 400,000 barrels a day. Despite more supply on the market, the Chartmaster sees prices bouncing from here. Let's get out of Carter Worth to break it down. Carter.
Yes, quite a ride, and it just gets down to this before we look at the charts. A 5-week sell-off from 85.50 to 62.50, down some 27%. Do you play for a bounce? I think you do. First chart. What we know is you have a well-defined series of higher highs, each of which has failed at that internal trend line. You can see the annotations there, the down arrow. So we dropped 16% in March, we dropped 20% in July, and then we dropped 27%. Look at the next chart. Look where these sell-offs stopped, right at the lower band of this megaphone, if you would like to call it that. But the point is, we touched the line, we bounced beautifully today, big reversal day. So if you look at the next chart, where might we be headed? I think you get back to sort of the middle of the range, the middle of the megaphone. You can see in this next one, there's a line that I've drawn that sort of projects to 75. And the final chart, I've simply circled that level and drawn an up arrow, which is to say a reversal after a 27% sell-off after 5 weeks down, you get more than just a barrel or two. So play for the bounce.
And it could be quite the bounce if you're right, Chartmaster, and you tend to be. So, Tim, if the Chartmaster is correct, you've got a few ways that you might want to play the bounce in oil. Dare we say the trade school is in session with Tim. Take it away.
I like the trade school. I like Carter's call, and we listed Carter on a lot of different fronts. In oil, what I hear him saying is in an environment where demand is a little bit choppy but going higher, this is a great place to be buying oil. It's a great place to be an investor, not a trader, the professor says. And I mean that. So let's go into the three names. First one's Exxon. Is Exxon sexy again? No, because being sexy is not sexy in the oil space. And in fact, for Exxon, it's about less CapEx. It's about higher free cash flow. It's about more downstream and chemicals. And it's about a dividend break even of $35 Brent so that this company can kind of do what it always did. And I think that's really where Exxon is. I think it's actually a perfect stock to own in this oil environment where I think oil will go higher, but I don't think it will soar. Then we have Chevron, and I'll call Chevron the company that, believe it or not, Exxon wants to be. And actually, Chevron so far ahead of the integrated peers in terms of running efficiently, cutting CapEx. They've said $15 billion in CapEx for 22. It's the bottom end of the range. It's a small increase, but they're going to still crank out, $3 billion or so in the Permian. They're still going to be, raising the dividend north of $65 a barrel. I think they can do that. And then finally, Schlumberger, who also, oil service stocks are not what they used to be. And I don't think Schlumberger wants to be what they used to be either. Again, a company that's focused on technology, a company that's focused on free cash flow. If you look at their last couple of quarters of numbers, first of all, enormous debt pay down, enormous free cash flow generation, again, relative to themselves. You don't necessarily need to see drilling go berserk. These guys are at the front of the list. They're best of breed, and you can be, that's right, an investor in oil companies, not necessarily a trader. They're run differently, and we've talked about that.
Yeah, thank you very much for the trade school, Tim. So, Bonawyn, do you like some of Tim's ideas here? And I do love the comment that Chevron is the company that Exxon wants to be.
I think Tim makes a lot of great points, and I really like how he came out. I'm not going to call it a disclaimer, but it's essentially a proclamation. He's playing it as an investor, right? And I think a lot of times, particularly over the last 2 years, we've gotten caught up in this hype, seeing all these massive moves and the crazy FOMO. You've got to have some core holdings as well. And this seems like a good point to kind of like put on some of those names. Now, I am a proponent of clean and green energy, but I think that there's enough room for both, right? We can all sit at the table going out of Thanksgiving into holidays together. I think you kind of want a well-shaped, rounded type of portfolio here. I certainly like playing it through the integrateds or the services much more than I would the ETF. I think that the last kind of bust cycle that we had, where that USO ETF was reshaped in terms of the holdings, swaps, and things of that nature. It does not track the commodity. And so, I second his call that the best way to get exposure, if you're bullish this thesis, is through the integrated and the servicers. So yeah, I mean, I love to argue, and I wish there was more debate here, but I really think he hit the nail on the head.
Yeah, costs are down. Cash flow is up. Guy Adami, in the past, I do remember that you have liked the SLB, Schlumberger. Do you still?
I do, but I'll see your Schlumberger and I'll raise you a Halliburton. But Tim's spot on, and Bonawyn echoed and made great points. But look at Halliburton. I mean, I thought it was off to the races in October. Stock was trading 27 and it looked like a lot of upside. Obviously, everything stopped on a dime, but it's still in an uptrend. At current prices, it's probably trading at 13.5 times next year's numbers, and you probably have about close to 35–40% EPS growth. Not that that's necessarily the reason to buy it, but the stock is just too cheap here, and I think it's going to bounce off these levels. So I'm with Tim and Bonawyn. I'll see you, Schlumberger. I'll raise you an HAL.